An option is a financial contract that gives an investor the right to either buy or sell an asset at a predetermined price by a specified date. There are two types of options: call option and put option. Call option allow the holder to buy and put option allow the holder to sell the asset. Consider the situation. There are two friends, Anand and Balu. Anand is actively evaluating an opportunity to buy 1 acre of land that Balu owns. The land is valued at 5 lakh rupees. Anand has been informed that in the next 6 months, a new industrial project is likely to be sanctioned near the land that Balu owns. If the industry news turns out to be a rumor, then Anand would be stuck with a useless piece of land. Balu is quite clear about selling the land if Anand is willing to buy. Anand wants to play it safe. He finally proposes a special structured arrangement to Balu, which Anand believes is a win-win for both of them. Anand pays an upfront fee of 1 lakh rupees today. Consider this as a non-refundable agreement fees that Anand pays. Against this fees, Balu agrees to sell the land after 6 months to Anand. The price of the sale, which is expected 6 months later, is fixed today at 5 lakh rupees. Because Anand has paid an upfront fee, only he can call off the deal at the end of 6 months, Balu cannot. In the event Anand calls off the deal at the end of 6 months, Balu gets to keep the upfront fees. Clearly, the price of the land will vary based on the outcome of the industrial project. However, irrespective of what happens to the industry, there are only 3 possible outcomes. Once the industrial project comes up, the price of the land would go up, say it shoots up to 10 lakh rupees. The industrial project does not come up, people are disappointed, the land price collapses, say to 3 lakh rupees. Nothing happens, price stays flat at 5 lakh rupees. We will now step into Anand's shoes and think through what he would do in each of the above situations. Scenario 1. Price goes up to 10 lakh rupees. Since the industrial project has come up as per Anand's expectation, the land price has also increased. So how much money is Anand making? Well, here is the math. Buy price equals 5 lakh rupees. Add agreement fees equals 1 lakh rupees. Remember, this is a non-refundable amount. Total expense equals 5 lakhs plus 1 lakh equals 6 lakhs. Current market of the land equals 10 lakh rupees. Hence his profit is 10 lakh rupees minus 6 lakh rupees equals 4 lakh rupees. Scenario 2. Price goes down to 3 lakh rupees. It turns out that the industrial project was just a rumor, and hence there is a sudden rush to sell out the land. As a result, the price of the land goes down to 3 lakh rupees. Remember, the sale price is fixed at 5 lakh rupees, 6 months ago, plus he had paid 1 lakh rupees towards the agreement fees. Which means he is in effect paying 6 lakh rupees to buy a piece of land worth just 3 lakh rupees. Clearly this would not make sense to Anand. He would simply walk away from it and would not buy the land. However, do note, as per the agreement, Anand has to let go of 1 lakh rupees, which Balu gets to pocket. Scenario 3. Price stays at 5 lakh rupees. For whatever reasons, after 6 months the price stays at 5 lakh rupees and does not really change. Cost of land equals 5 lakh rupees. Agreement fee equals 1 lakh rupees. Total equals 6 lakh rupees. Clearly it does not make sense to buy a piece of land at 6 lakh rupees when it is worth 5 lakh rupees. For this reason Anand will call off the deal and in the process let go of the agreement fee of 1 lakh rupees, which Balu obviously pockets. Let us summarize a few important points now. The payment from Anand to Balu ensures that Anand has a right, remember only he can call off the deal, and Balu has an obligation, if the situation demands, he has to honor Anand's claim. The outcome of the agreement at termination, end of 6 months, is determined by the price of the land. Without the land, the agreement has no value. Land is therefore called an underlying and the agreement is called a derivative. An agreement of this sort is called an options agreement. Since Balu has received the advance from Anand, Balu is called the agreement seller or writer, and Anand is called the agreement buyer. In other words, since this agreement is called an options agreement, Anand can be called an options buyer and Balu the options seller or writer. The agreement is entered after the exchange of 1 lakh, hence 1 lakh is the price of this option agreement. This is also called the premium amount. Every variable in the agreement, area of the land, price and the date of sale is fixed. As a thumb rule, in an options agreement the buyer always has a right and the seller has an obligation. Let us now attempt to extrapolate the same example in the stock market. Assume a stock is trading at 67 rupees today. You are given a right today to buy the same 1 month later, at say 75 rupees, but only if the share price on that day is more than 75 rupees. Would you buy it? Obviously you would, as this means to say that after 1 month, even if the share is trading at 85, you can still get to buy it at 75 rupees. In order to get this right, you are required to pay a small amount today, say 5 rupees. If the share price moves above 75 rupees, you can exercise your right and buy the shares at 75 rupees. If the share price stays at or below 75 rupees, you do not exercise your right and you do not need to buy the shares. All you lose is 5 rupees in this case. An arrangement of this sort is called option contract, a call option, to be precise. After you get into this agreement, there are only 3 possibilities that can occur. The stock price can go up, say 85 rupees. The stock price can go down, say 65 rupees. The stock price can stay at 75 rupees. Case 1. If the stock price goes up, then it would make sense in exercising your right and buy the stock at 75 rupees. The P&L would look like this. Price at which stock is bought equals 75 rupees. Premium paid equals 5 rupees. Expense incurred equals 80 rupees. Current market price equals 85 rupees. Profit equals 85 minus 80 equals 5 rupees. Case 2. If the stock price goes down to say 65 rupees, obviously it does not make sense to buy it at 75 rupees, as effectively you would spending 80 rupees, 75 plus 5, for a stock that's available at 65 rupees in the open market. Case 3. Likewise, if the stock stays flat at 75 rupees, it simply means you are spending 80 rupees to buy a stock which is available at 75 rupees, hence you would not invoke your right to buy the stock at 75 rupees. For reasons we have discussed so far, whenever you expect the price of a stock to increase, it always makes sense to buy a call option.